According to the Brookings Institute, nearly 2 billion people will be added to the middle class in the next decade or so. That's 2 billion people. Just to put that into context, that's the size of all of the Americas and all of Europe combined. Pretty staggering, and a huge opportunity for businesses to sell their goods and services to. So what does that mean for your investments? We're going to focus on primary areas of growth. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. My name is Will, and I'm joined again by Brian and Elliott. So, you guys, what is growth and why is it so important?
Well, when we speak of volume growth, what we mean is the ability to sell more units of whatever it is you're producing. We talk a lot about that the goal in investing is simply to compound at high rates of return over long periods of time. And in order to be able to keep compounding and growing your capital, you have to have a long runway to be able to keep reinvesting at those high rates.
Yeah, and I just make the point that you can either, in order to get that unit growth, you can either sell more units per user or to many new users. And that's why the growing middle class statistic that Will cited at the beginning is so exciting from a volume perspective.
Yeah, I mean, think of the converse. If you don't have volume growth, then your cash flow's remaining constant. And the only way to get a higher return on a constant cash flow is to buy it cheaper. So, for example, if you buy something at 10 times free cash flow, then one might expect that they could get the inverse of that, a 10% rate of return. If you want to get a much higher rate of return, you got to buy it at, say, 5 times cash flow, take the inverse so that you can get a 20% return.
And constant volume growth isn't the worst case. In many cases over time, volumes in industries start to decline, and so you can only depend on raising prices for your growth. And so even if you are in an industry like tobacco where you've got addictive properties and it's also brand loyal, eventually those volume declines will overwhelm the pricing power.
So great thoughts. So is all growth equal then?
Definitely not. I mean, I would bring up 2 points. I'd bring up profitable growth versus, and then also pure profit growth. So, if you don't have pricing power, which is something we consistently talk about at YCG, if you don't have pricing power, it won't matter if you have a lot of revenue growth. I think kind of the quintessential example there is the airline industry, which is one of the fastest growing industries since Kitty Hawk. But yet, if you add up all the profits since the beginning of Kitty Hawk, it's actually the total sum profits in the industry are negative. And so in order to get profitable growth, you need to have pricing power so that you can maintain margins that provide returns in excess of your cost of capital. The second thing I'd bring up is that this idea of pure profit growth. So, if you're wanting to grow in an industry, typically then we talked about just now, you want to be able to reinvest. So if you want to make more toothpaste and you want to sell it across the globe, maybe now you start building a factory in India, in South America, in the Philippines. You build more factories to be able to sell more units. But even better is something like software. Consider like Adobe or Intuit, where every new unit sold is on a platform or this piece of software where then you're able to grow without needing to put a lot of capital into something. Or another thought that comes to mind is like MasterCard, where they've got this massive networked platform across the globe and very little capital is needed. They can essentially just grow as a toll taker on the growth in all of global GDP over time without needing to reinvest. And so therefore your returns on invested capital are actually going up over time.
So another thing that we talk a lot about is finding industries that are growing at least as fast as GDP. Why is that so important to look at?
Well, it aids in being able to have pricing power, because if you're not growing at least as fast as GDP, then you're going to bump up against a lid. And so your pricing power is really only as strong as the industry. Eventually, you can't overcome a declining industry.
But if you're invested in an industry that's growing in importance over time, then you kind of get in many cases, if you own one of those dominant networks, then you get the best of both worlds. You get pricing power and increase volume.
So how do we identify these areas of growth?
The way we like to think about it is if you start with sort of an income of 0 and sort of start to move up, for a while, your income is going to be totally focused on your survival needs. But over time, with innovation bringing down the cost of survival and with your income rising, you get to a point where you can start to spend on other things. And as society gets wealthier and wealthier, those survival costs kind of level off or start to decline. And then we can spend a greater percentage on things, goods focused on social comparison, such as luxury goods, cosmetics, advertising, entertainment like movies and TV and social media, video games, and then also on growing and protecting the savings that you build up as you and the society become wealthier. And that's through, financial services such as wealth management and insurance.
Awesome points. Very important to look at this as the overarching investment rationale and what we look at. All the stocks we've mentioned should not be considered a recommendation to buy or sell the stock. Obviously, consult your financial advisor for your specific situation. You can also request from YCG a list of all the securities that we've recommended over the last 12 months. Thanks for watching. Check out our other videos and we'll see you next time.